Welcome back to Investing Talk Podcast.
Great to be here.
Today we're tackling a name many of you probably know well, maybe even shopped at recently. American Eagle Outfitters. The big question we're asking is now a good time to buy?
It's definitely a hot topic. AEO's had, well, let's call it an interesting year so far.
Absolutely. So we're going to unpack everything, the financials, what the analysts are saying, the recent buzz.
Yeah.
Basically give you the full picture so you can get a real sense of where things stand.
Exactly. We want you to walk away feeling like you've got a solid handle on the company and its prospects.
And hey, before we dive in, if you enjoy this kind of analysis, please do subscribe to the podcast. Maybe leave us a like or a comment.
Yeah, and if you feel like supporting the show, you can always buy us a coffee.
Yeah.
The link's usually in the description.
We appreciate that. Also, let us know in the comments if there's a specific company you'd like us to look into next time.
We do read those. Okay, so American Eagle, where do we start?
Let's start with the fundamentals. What's really going on behind the headlines? Because it feels like they've been on a bit of a roller coaster.
That's a good way to put it. Q1 for their fiscal 2025 definitely showed some turbulence. Revenue was $1.1 billion.
Which sounds like a lot, but how does that compare?
Well, it's actually down 5% compared to the same time last year. And comparable sales, which is a key metric in retail, were down 3% overall.
Okay, so declines across the board. Even for Aerie. I thought Aerie was the growth engine.
It usually is, but even Aerie was down 4% in comps. The main American Eagle brand was down 2%. So yeah, softness pretty much everywhere in Q1.
And this is quite a shift, right? What did the previous year look like?
A completely different story, actually. Fiscal 2024, which ended earlier this year, was strong. They pulled in $5.33 billion in revenue, up over 1% year over year.
Okay, slight growth, but the earnings.
But that's where it was really impressive. Earnings were up almost 94% year over year, hitting about $329 million.
Wow, nearly doubled earnings. So to go from that to a 5% revenue drop, and what about profits in Q1?
Yeah, that's the other shoe dropping. They went back into the red. The standard GAAP operating loss was $85 million.
Wow.
And even the adjusted operating loss, which tries to filter out some one-off things, was still a loss of $68 million.
Okay, you mentioned adjusted figures filtering things out. Was there something specific impacting that Q1 loss?
Yes, a big one. Included in those numbers was a $75 million hit from inventory write-downs.
$75 million, that's quite a chunk.
Yeah.
So basically clearing out old stock?
Exactly. Getting rid of stuff that wasn't moving. And, related to all this uncertainty, management actually pulled their full-year guidance for 2025.
Right. Never a sign of confidence when guidance gets withdrawn. But hang on, those inventory write-downs, while they hurt the bottom line now, could that actually be a good thing long-term? Like ripping off a Band-Aid?
That's the argument, yeah. It's painful up front, obviously contributes to that big loss, but it is a proactive step.
How so?
Well, it signals they're serious about fixing their inventory issues, which have plagued a lot of retailers. Clearing out the old makes space for the new, hopefully more profitable stuff. It shows they're willing to take the hit now to, get healthier down the road.
Okay, that makes sense. Sort of cleaning house. But it still leaves that cloud of uncertainty from the withdrawn guidance.
Absolutely. It tells us they just don't have a clear view of how the rest of the year might shake out, but there is a potential bright spot they're hoping will help.
Let me guess. Is this the Sydney Sweeney campaign I've been hearing about?
That's the one. It launched recently, got a ton of buzz, went viral pretty quickly. The hope is that this kind of high-profile marketing can really boost visibility and, crucially, drive sales back up in the coming quarters.
Marketing can definitely move the needle, especially with that younger demographic AEO targets. Okay, so they're taking steps to clean up inventory, hoping marketing helps. What about their overall financial health? Are these losses and write-downs putting them in a precarious position, liquidity-wise?
It's a fair question. Operating cash flow was negative in Q1, which definitely increases near-term risk. You don't want to see cash flowing out of the business.
Right.
However, looking at the analysis, there aren't any immediate, red flags about critical liquidity problems. Historically, AEO's actually been pretty conservative with debt and usually keeps a decent amount of cash on hand.
So they have some cushion to absorb this difficult period.
It appears so. They seem to have the balance sheet strength to navigate this, assuming things start to improve, of course.
Good to know. Now let's zoom out a bit. How does AEO fit into the bigger retail picture? It's a tough market out there, especially for mall stores.
It really is. You've got shifting consumer habits, intense online competition, It's hitting everyone. AEO is still a major player, though, especially in that mid-tier apparel space. They've got real brand power, particularly with younger shoppers.
But a Sweeney campaign probably helps reinforce that.
Definitely helps keep them relevant. But yeah, the challenges they're facing, inventory gluts, needing to discount, figuring out what consumers want next,
Yeah.
those are sector-wide headaches right now.
So it's not just an AEO-specific meltdown. It's partly the environment they're operating in.
A big part of it, yes.
How do they compare to their direct competitors? Like Abercrombie and Fitch comes to mind.
That's a really interesting comparison right now. Abercrombie has had a remarkable turnaround story themselves. And if you look at how the market values them,
Yeah.
Abercrombie trades at much higher multiples. Their price-to-sales ratio, for instance, is around 1.2.
Okay, 1.2 times sales. And AEO.
AEO is way down at 0.39.
Wow, that's a huge difference. 0.39 versus 1.2.
It's stark, isn't it? It tells you the market has a lot more faith in Abercrombie's current performance and future growth right now.
Or does it suggest AEO might be undervalued if they can get their act together?
Yeah. That's the bull case, exactly. If AEO can stabilize the ship, improve margins, get sales growing again, there could be significant upside just to close that valuation gap with peers like Abercrombie.
Okay, this leads perfectly into valuation.
Yeah.
Let's decode the numbers. The stock price was what, $10.74 recently?
Yeah, as of August 4th, $10.74.
So we mentioned the price to sales ratio is low at 0.39. What about price to book?
Price to book is about 1.26. And again, both of those metrics, PS and PB, are well below AEO's own historical averages.
So cheap compared to its past and cheap compared to Abercrombie. What about price to earnings, PE?
Well, because they had that loss in Q1, a forward-looking PE based on current estimates isn't very meaningful right now. It gets skewed by the negative number.
Right.
But if you look back on a trailing 12-month basis, incorporating some of that stronger performance from last year, the valuation definitely appears compressed. That's the analyst term for it. Basically cheap.
Compressed.
Ah.
I like that. So the market seems to be pricing in a lot of negativity. What do independent analysts think its fair value should be? Is there a consensus?
It's interesting. Some independent analysis looking at the sum of its parts, like valuing Aerie and the AE brand separately and using historical multiples, actually puts the fair value way higher, like $40.61 per share.
$40.
Yeah.
Compared to $10.74. That's a massive difference.
It implies huge undervaluation. And it's a big if they can get back to their normal profit margins.
Okay, that's one view. What about the broader consensus among Wall Street analysts? What are their price targets?
The average 12-month price target is currently $15.40.
$15.40. So still suggesting decent upside from $10.74, about, what, 16% potential?
Roughly, yeah. And some of the more optimistic analysts have targets up around $17.44.
But all these targets, especially that $40 number, hinge on a successful turnaround, right?
Absolutely. These models are very sensitive to assumptions about sales recovery, margin improvement, basically management executing successfully and the market normalizing.
Okay, let's switch gears to the technicals. What's the chart telling us? The stock fell hard, you said.
It really did. Tumbled from over $20 early in 2025 down to where it is now, just above $10. That Q1 report and the general retail gloom really hit it hard.
Has it found any kind of footing down here? Any support levels?
It looks like it. There seems to be pretty solid support established right around that $10 to $10.50 area. It's bounced off that zone recently.
Okay, so potential floor.
Yeah.
What about looking up? Where's the resistance, the levels it might struggle to get past?
The first key resistance area looks to be around $14 to $15. That aligns pretty well with that consensus price target, interestingly. And then above that, you'd be looking back towards the $20 level where it fell from.
Got it. And what are the momentum indicators saying? Like RSI or the MACD? Are they showing any signs of life?
Well, the moving averages are still pointing downwards, confirming the recent bearish trend. The RSI, the Relative Strength Index, did dip into oversold territory in late July.
Which sometimes signals a bounces do.
Right. Often, yes. And we did see a brief bounce, especially around that Sweeney campaign news. But volatility is still really high. And the MACD, another momentum indicator, is still signaling bearish momentum overall.
So maybe a short-term bounce off support. But the underlying trend indicators are still weak.
That seems to be the picture, technically speaking. Still challenged.
Okay, let's look ahead now. Catalysts and risks. What's the general market sentiment around AEO right now, given everything we've discussed?
It was pretty negative right after the Q1 results and the guidance withdrawal. understandably so.
Yeah.
That viral marketing launch in July definitely injected some temporary positivity. It got people talking, generated buzz. But as the initial price spike faded, sentiment seems to have cooled off a bit again. It's cautious.
And the analysts covering the stock, you mentioned the price targets, but what's the overall rating distribution? Is it mostly buys, holds, sells?
It's pretty mixed, actually, which kind of reflects the uncertainty. Across about 39 analysts, the overall consensus is technically buy,
Right.
but the breakdown is interesting. About 33% are strong buy, 21% buy, but then you have 38% at hold, and just a small sliver are sell. Another survey puts the average rating squarely at hold.
So a lot of fence sitting among the holds, it sounds like, waiting for more clarity.
Exactly. And another data point, no significant insider buying or selling reported recently, so management isn't sending strong signals with their own wallets either way.
Okay, mixed signals all around. What could potentially change the narrative? What are the key catalysts investors should watch for? Short term first.
Short term, all eyes are on the next earnings report, Q2. That's going to be huge.
What needs to happen there?
If they can show stabilization in gross margins, meaning less heavy discounting, or if revenue decline slows or even flattens, that could spark a rally. Also, any positive updates on resolving those inventory issues would help.
And the marketing push.
Yes, continued positive results or data from the Sydney Sweeney campaign showing it's actually driving traffic and sales will be key. Plus, the back-to-school season is critical for apparel retailers like AEO. A strong back-to-school could really boost Q2 and Q3.
Makes sense. What about longer-term catalysts beyond the next quarter or two?
Longer term, look for signs of operational improvements. Things like optimizing their supply chain, maybe closing underperforming fulfillment centers to cut costs and improve margins.
Structural changes.
Right. Also, any strategic moves like mergers and acquisitions. Could AEO buy a smaller, faster-growing brand? Or could AEO itself become an acquisition target, maybe for private equity, given the low valuation? That's always a possibility.
Interesting. A buyout could definitely unlock value.
And then there's the macro picture. If consumer spending on discretionary items picks up more broadly, that lifts all boats in the retail sector, including AEO.
Okay, so potential paths to improvement exist. But let's talk risks. What could go wrong? What are the stock-specific hurdles?
The big one is continued margin pressure. If they have to keep discounting heavily to move inventory, profits will suffer. Another risk is that the marketing campaigns, despite the initial buzz, just don't translate into sustained sales growth or better margins.
All sizzle, no steak, potentially.
Could be. And that withdrawn guidance just creates ongoing uncertainty. It makes it hard for investors to model the business and feel confident. Any further inventory problems would obviously be a major negative, too.
And the broader market risks, things outside AEO's direct control.
Well, the whole mall-based retail sector remains challenged. If consumer spending shifts further away from apparel or towards different channels, that hurts them. Competition is fierce, not just from other mall stores, but from online giants and fast fashion players.
Like Shein or Temu.
Exactly. And then you have the macroeconomic risks. Rising interest rates could curb spending, inflation could eat into purchasing power, or a full-blown recession would obviously hit discretionary retailers like AEO very hard.
Lots to worry about there, too. Okay, let's try to synthesize all of this. Based on everything, the fundamentals, valuation, technicals, catalysts, risks, if you had to give AEO an overall rating out of 10 right now.
Considering all those factors, the analysis lands on a rating of 6.5 out of 10.
6.5. Okay, so slightly better than neutral, leaning positive, but not a screaming buy. What's the core thinking behind that 6.5?
The rationale is basically this. AEO looks like it offers deep value at its current share price, around $10.74. There's significant potential upside if the turnaround works and if the marketing drive pays off in a sustained way.
The ifs are doing heavy lifting there.
They are. We have to acknowledge the real stress on the business right now. Falling sales, squeezed margins, the withdrawn guidance. Those are serious headwinds.
But you mentioned their financial health seems okay.
Right. It appears manageable. They took proactive steps with the inventory, and the underlying brand, particularly Aerie, still seems to have strength and resonate with consumers. That enduring brand power shouldn't be underestimated.
And the technicals and sentiment, what role do they play in that 6.5 rating?
They suggest a short-term bounce is definitely possible, especially if we get some good news or if the overall market firms up. But, and this is crucial, the risk level is still high because of those recent losses and all the uncertainty in the retail sector. It's not a smooth ride.
So putting it all together, who is this stock potentially for right now? Short-term traders looking for a bounce, or long-term investors betting on the brand?
Based on the analysis, it probably leans more towards being suitable for short-term trading opportunities, but anyone doing that needs really tight risk management. Stop losses would be essential given the volatility.
And for long-term investors?
They might want to be more patient, perhaps wait for concrete evidence that margins are recovering sustainably or that sales trends are firmly reversing. However,
Yes.
for investors with a higher tolerance for risk, who believe in the long-term value of the brands, especially Aerie, you could argue that these deep value levels around $10, $11 might be an attractive entry point for starting a small position.
Kind of dipping a toe in.
Something like that. Understanding the risks, but seeing the potential reward if things turn.
And just for context again, not advice, did the analysis suggest any specific price levels for trading? Like entry, stop loss, take profit?
Yeah, for informational purposes only, the suggested entry range was around $10.50 to $11. A potential stop-loss level for trading was pegged at $9.25, and a take-profit zone was suggested between $14.25 and $15.
Which lines up with that resistance level and the analyst consensus target.
Exactly. It provides a framework based on the current technicals and targets.
Well, that was quite an exploration of American Eagle Outfitters.
Yeah.
It really feels like a company at a crossroads, doesn't it?
It certainly does. Facing clear challenges, taking some tough medicine with those write-downs, but also possessing strong brands and potential turnaround levers like marketing and operational tweaks.
It really captures the complexity of investing in retail today. You've got the company specifics, but also these huge macro and sector trends swirling around them.
Absolutely. It's a constant balancing act.
So maybe a final thought for our listeners to chew on. What does AEO's current struggle and its potential recovery path tell us about the health of the broader consumer discretionary sector right now? And maybe more specifically, just how much impact can one big viral marketing campaign truly have on turning around a company's fundamental performance these days?
Great questions to ponder. Is it a temporary sugar rush, or can it genuinely change the long-term trajectory?
Something to think about. Thanks, everyone, for tuning in to Investing Talk Podcast. We'll catch you next time.
Thanks for listening.